Welcome back to another episode of the Savvy Wallet podcast. Today we have Dan, who is the Chief Research and Investment Officer at Morningstar. Dan, how are you doing today?
Actually, it's really good to see you. Thanks so much for coming along.
Welcome. I've had a great time at the Morningstar Investment Conference, and we're recording this at the end of this today. I feel like it's a good way to end the day. We're going to get a lot of value from you, conversation. I want to start with this question. What do you believe are the most critical principles for long-term investment success, and how can investors apply them today?
Yeah, of course. Well, there's really two principles that people need to think about. The first is that when investing, take a fundamental approach. There are lots of different ways to invest. Most aren't very successful, but nevertheless, they seem attractive when people start off. So people will look at charts, or they'll look at the news, or whatever it is. But in reality, if you want to invest successfully, then you have to do your research. You have to think deeply about what drives returns, what has worked over the long period of history that we've been investing, and therefore build that picture of what's going to do well in the future and what's not going to do well. So understand the fundamental characteristics of a business, and you won't go far wrong. So that's the first one. The second one is that price matters. So when you're buying a fund, buying an investment, think about what the fees that you're paying are. The lower the fees, the better. That tends to be where a lot of people trip up. Or as another way of thinking about it, if you're buying a company, a stock, a share, then try and buy that stock and share when it's cheap, when everyone else hates it, because that's when you're likely to get the best returns.
And, it takes me to my next question because, obviously right now we are in a market where some of the most popular stocks, so Tesla's, your Nvidia, off their all-time high, right? And it's a market that's a bit turbulent, especially as we've got a new US president. I don't want to say he's causing trouble, but maybe he's causing a bit of trouble for some of the investors. So I feel like a lot of investors do struggle with staying the course, especially now. I've had a few people on my podcast and the comments say, I'm looking to sell my kind of investments. How can investors manage their emotions and avoid making reactive decisions that hurt, their long-term investment goals?
Yeah, actually, so the first thing to say is that you can only reach your financial goals if you stay invested. And the biggest challenge, as you say, is that most people kind of fall off the path. They don't stay the course, they don't get to where they want to be, and they end up being disappointed. The second thing to say is that that's really natural, because if you think about an environment where you're surprised, then you typically have three main responses. So some people freeze, they don't do anything at all. Other people try and fight their way out of it by buying and selling and lots of activity, and other people just fly away. They just want to sell investments and run. That has been something that's been instilled in us over millions of years of evolution, when if you are threatened, you get out of the way. And we've all come from people who, when they were threatened, they got out of the way because otherwise they wouldn't have had descendants. So it's entirely natural that you feel like you want to do something or get out of the way or sell investments or whatever. But all of that evolutionary conditioning that we've subjected ourselves to does not work with investment. And so if you want to be a successful investor, you have to overcome that. Now, the main thing is to try and avoid being surprised. So if you don't have very strong expectations of what the future is going to hold, you're not going to be surprised. You're not going to make those mistakes.
Yeah. I love what you said about the evolution. You're absolutely right. I feel like sometimes we forget kind of where we came from, and a lot of that does overtake what we do in the modern day, which is completely different.
Exactly right. That part of our brain hasn't changed that much, and it's always going to encourage us to do the wrong thing in investment. And that's why it's so hard.
Yeah, amazing. So my next question for you is, while long-term principles are key, many people do feel overwhelmed by the complexity of investing. What's a simple, actionable strategy that someone can implement today?
Well, the most important thing that anyone can do is start saving. So regardless of where you save and what your investments are, the first step is to just start saving, and to do it consistently, do it every month, and try and increase over time. And people say, well, that's obvious, but it's difficult to do. And actually, the biggest key to success is that long-term investing, doing it consistently. A saying that people often use in investment is that it is time in the market, not timing the market. So often we can focus on the intricacies of investment, as you say, and get worried about what the news is saying or what's happening in markets. Forget about it. You just want to be invested for a long period of time. Obviously, you would rather be invested in something good and successful, but that doesn't have to be the first thing. The first thing is saving and getting that money to work.
Amazing. And I completely agree. I think getting into the habit of saving is what's going to ultimately get you. I think I've been investing plus 10 years, but when I started, it was an index fund. Yeah, I got comfortable, now starting to invest in stocks a long time,
Yeah.
After. So there's a lot of talk, especially invest in the US markets, invest in S&P 500. There's been, let me not say, there's been maybe a romantic relation with investors and, in the US stock market. But I feel like that then also presents potential opportunities in other markets. So in terms of from a UK point of view, what is Morningstar's kind of view on the UK and the potential on that to do better?
Yeah, of course. So the UK market has been in the doldrums for years. As you say, people have got really excited about investing in the US, investing in tech. And as you mentioned, Tesla and Nvidia, all these great companies, and they are wonderful companies. But certainly at the end of last year, and still to some extent, they look pretty expensively priced. And so it's like anything else. If you overpay, you don't get a good deal. And so that's true with investments. Whereas the UK has been in the doldrums. We all know about the bad news and the negativity that surrounds the country and therefore has impacted the market. In reality, we've got a bunch of world-class firms that are global in nature. They just happen to have started in the UK or be based in the UK. It's a great market, and it's probably one of the most attractive markets in the world at the moment. Now, it's not as attractive as it was, let's say, 6 months ago, because people are starting to wake up to this. But if you're a long-term investor, it still offers good long-term returns.
And can you elaborate on the factors that are influencing your outlook on why you think that, UK equities and bonds are attractive?
Yeah, absolutely. So I would just caution with bonds. So the difference between stocks, as you know, you're owning a piece of company. With bonds, you are lending money. And that's not as attractive in the UK as other markets. So again, important for people to understand, just because they're investing in the UK, they've also got to try and invest in the right things. But stocks, what's really driving our view of returns is looking at the underlying characteristics of the businesses, whether they're likely to grow their profits into the long term, and then what we're paying for that profit growth. Now, so often, people look at the sort of events that we've seen over the last month, which you mentioned, all of that volatility, say, well, surely this is really important. Well, it's not, because with a company, what happens in the far future is typically more important than what happens over the next year or so.
Amazing. And let's talk a little bit about the macroeconomic trends, right? What role do they play in shaping a long-term UK investment outlook?
Well, they're just entertainment, frankly. They're just something for us to look at, but not take too seriously. So the way that we think about economics is that it leads to disaster if you take any sort of macroeconomic view and then try to apply that to investment. Investing and macroeconomics are very different things. What macroeconomics does, though, is it helps you highlight what some of the risks might be in the future. So we talked earlier about not being surprised. Well, if you're looking at a range of possible economic scenarios, then you're thinking about the things that might surprise you if you're not paying attention. So macroeconomics is very good at highlighting risks, but when thinking about investing, try and ignore the macro, because that's always noisy, and it's not always linked to what's really happening at the companies you're investing in.
Yeah, and it's so interesting you say that, because a lot of investors ignore that, right? A lot of the investors that on the tariff news ignored that and just would have sold their investments because it's like, oh my God, we got these tariff news, these companies are going to be effective in the short term, kind of almost abandoning their long-term plans.
Yeah, and we saw that, and it's just tragic because people would have sold out when these assets got cheap, having owned them when they're expensive, and then sat on money that they now don't know what to do with because the price have gone up again. That's exactly why you've got to stay in your investments over the long term. Much more important than the particular investments you own.
Exactly. You just have to stay the course, because how would you know when the tide's going to turn to the positive? It's very difficult to do.
Exactly right. And over what time period are you measuring? So just because you think it's going to be positive long term, that doesn't mean the next day or week or month, even 6 months, will go in your favor. It sometimes takes a long time for an investment idea to play out, and that's why, as you say,
Yeah.
you've got to stay there for long term.
Yeah, amazing. Thank you. So the next question I have for you was, what strategies would you suggest for building resilience in an investment portfolio, especially during uncertain times, given rising inflation and cost of living as well?
Yeah. So when thinking about the future, what we need to understand is that we don't know what will happen. Sometimes it feels like we do, but frankly, we don't. And so when thinking about how you build that into a portfolio, then there's really two ways of thinking about a portfolio. One is a bit like running on a racetrack. So when you're running on a track in an arena, as you know, it's lovely and flat. It's entirely predictable. You know where you're going next. And it's just a perfect course. And you can go very quickly, but you're just going in one direction and it's all plain sailing. That's not how investment works. Investing is much more like cross-country running or fell running, where you don't necessarily know what's around the corner, where the terrain might be really difficult. And so you've got to build a portfolio that can cope with whatever the future throws at you. And so that means normally that you have to have a range of different investments that will behave in different ways, depending on what the outcome is. And that means that your portfolio will probably go a little bit more slowly than it would do if you predicted the future perfectly, but nobody can. And so you'll go a bit more slowly in some situations, but you'll be very glad that you prepared for this range of possible outcomes.
Yeah, so you think diversification is very critical?
It is absolutely key. It is so important. And again, when people are building diversified portfolios, the mistake they often make is thinking, well, as long as I've got lots of things in my portfolio, that's diversification. It's not. The key to diversification is having things that behave differently given the same stimulus and not just having lots of things. So you have a very diversified portfolio with just 3 or 4 things in it. But most people don't think about that. They think you have loads of things in the portfolio, but often all those things they have will behave in the same way given a certain stimulus. So that's why understanding what diversification means in your portfolio is really key.
Yeah. Is there any kind of like certain factors you mean when it's like, okay, if I know I say in the video, but let's say company A, is there a certain factor that you would say, okay, it should behave well in this market, company B in this market? Is there certain factors that you're thinking about?
Well, that's the sort of thing that my investment team spends a lot of time doing, and it's expensive in terms of data and tools and all that sort of. So it can get very complex.
Yeah.
But very simply, what everyone can do is they can think about a particular asset or a holding and say, well, is that likely to do well if we have a period of high inflation? Is it likely to do well if you have a period of very low inflation or high growth or low growth? And by building up things that will behave differently in those 4 scenarios, then you can pretty simply build some diversification. And you can get more sophisticated as time goes on. And again, this is where tools on the internet, where your work, where even AI can help you understand how an asset will behave in different scenarios. So start simply, and then you can get more sophisticated over time.
Amazing. I really like that. The high inflation and high growth and low inflation, low growth it's a very interesting way to kind of model your portfolio, because it's like in different seasons, you have something that's always kind of performing.
Yeah, it is. So often I say investing is like gardening. And I say that because I'm kind of old, but I love gardening. But it's about having something in flower at all times.
Yeah.
And so whatever's going on in the garden, you've got something that's working for you.
Yeah, amazing. My final question to you today, Dan, is if you had to recommend one strategy for investors to build long-term wealth, regardless of market conditions, what would it be?
Well, the only thing you can really do is make sure that you're committed to staying invested. And so the best strategy that people can have is to not read the financial pages and try and avoid the economic news. Now, in reality, we know that's really, really difficult. So my second best strategy is just to save as much as you can. And if you can save a little bit more next month than you did last month, that is going to get you where you need to be.
Thank you so much, Dan. We really learned a lot in our shorter version of a podcast. Thank you. Do you have any final words for watchers and listeners?
Just remember that most people find investing really, really difficult. If you're finding it difficult, you are not alone. I find it difficult. Every professional investor I know finds it difficult. It is a struggle. It's a journey. Just stay on it.
Thank you. Thank you so much, Dan. I really appreciate you featuring on the podcast today. Thank you so much for tuning in to this episode of the podcast.